Hi everyone, good to see you again and thanks for coming. Before we start, please smash the like button, subscribe and choose all for the notification bell. Okay, done? Let's start. Now we'll be discussing about the effects of inflation to your stocks, investments and the economy. During inflation, each bill, coin or unit of money loses value. And we can't deny that inflation happens yearly. And this would be one reason you prefer real estates, gold, cryptocurrencies, NFTs, stocks, and bonds to accumulate more wealth. The Fed said that consumer price index reached 7% in 2021. High inflation causes people to afford fewer products and services due to price and service fee increase. If this is the case, those with fixed incomes yearly, without commissions, while promotion happens every 2 years of service, are in a very tight position. Even if your monthly income now is $10,000 a month, it may be able to buy 2 cakes only after 30 years. Yet that could happen since inflation rates differ yearly, and some events can trigger hyperinflation. This means if you cap your $2 million in a bank for 30 years without investment, that amount could only buy groceries and other goodies in a monthly budget in the future. Mostly, inflation is not good for stocks, but Steve Hank from Johns Hopkins University calculated that from 1900 to 2017, average yearly return on stocks is 11%. If inflation is 3%, there's still 8% left. However, in 1972 to 73, inflation is 6%. In 1974, inflation is 11%. In 1979 to 1980, inflation reached 13.5%. And even though they said that S&P 500 returned to performance, there's a 10-year loss. However, there is a healthy inflation. Very low inflation or stagflation is not good because it's a stagnation. Deflation prevents people from buying more goods and it won't be good for the growth of businesses and the economy. Inflation is not all bad, except if it's too high. The good one is the moderate inflation, which is beneficial for businesses, people and economy, and the stock markets. Banks and the Fed aim for this. This gives people more money to buy products and services, but the supply will not be high enough. If people have more purchasing power, they will buy more, but in this case, supply will not be enough for all. Prices can rise to match this, but many people and businesses will earn more money, and it will then be circulated to the economy through salaries, products, services, or investments. Why is this beneficial? It's because inflation also shows if people have more money to spend on things, products, or services. This means that people have higher pay, businesses are increasing in revenue, and the economy is going in the right direction. However, if it's too high, only few sectors would benefit. But look at Apple now. They have good revenue amidst the chaotic news and reports on possible market crash, etc. Well, it's still too early to decide, so we'll wait till the year ends. But remember, it's a mature blue-chip company. So going back to the sectors that could benefit from this, banks can gain from inflation because they can increase the interest rate on loans. Of course, if you're the borrower, this would be a huge handicap if you can't meet those interest payments. Even businesses can easily borrow loans also, because they are often in millions. However, if the opposite happens and there's low inflation, interest rates will also decrease. There are many complexities here, like monetary policies, etc., and we'll not go into those. Gold will not be affected much, unlike our bills and coins, so gold mining companies can still do well in an inflation. If you're an investor, gold and the stocks of the companies would be good choices. But always do your research because there's no exact formula to prevent losses and volatility changes over time, even for gold. Energy businesses and those in mining materials like aluminum and steel, from iron ore and scrap metal, also thrive during an inflation. Their prices rise and can give more revenue to the companies. Housing materials also increase these days. An example is the increase of at least 250% of steel prices in 2020 to 2021. Companies these days are also implementing green procedures due to the impact in climate change or environment, and by adopting those, costs will increase, which will lead to increase in prices aside from the number of demand. Still, market won't thrive only during high inflation, but during economic booms, because of economic growth increasing the demand against the supply. During the high lockdowns and not many vehicles use oil, stocks of these companies drop. However, if oil price rises, these companies will earn more, and their stocks will be good in your portfolio. Oil hikes are happening now, but electric cars are becoming common also. These vehicles could take over these generations of cars soon. Some companies are even planning to shift to produce electric cars only. So when you invest in these oil companies, always stay informed about the changes in the market. Still, there is no exact formula or one-for-all rules when it comes to stocks and inflation. For the effect of inflation in the short term, it's inverse or opposite. Inflation falls, stock prices rise, and if inflation rises, stock prices fall. Let's see. If the inflation is 2% and your return on your investment portfolio is 5%, your gain or real return is 3%. However, if inflation is higher than 5%, which is your return on investment, it becomes a negative return. Like your return is 5% minus inflation, that is 7%, you have a negative 2% loss. Yeah. And Warren Buffett and Charlie Munger are geniuses. We don't really know their detailed calculations or formulas when evaluating stocks, bonds, it's. For this, in finance, they use discounted cash flows for evaluations. But we'll not be talking about that now. So for your investments or when planning to invest in a high period of inflation, for the short term, value stocks are preferable, or those with lower current trading price than their intrinsic value. These shares perform well against income or growth stocks, and these are mostly those companies in maturity. You can add the blue chip stocks here. A business has different life cycles, like as humans. Once a business reaches maturity, or other blue chip stocks, revenues will not be so high, unlike the growth companies. An example is Coca-Cola or Procter & Gamble. They already spread all over the world, unlike Elon Musk's Tesla cars, robots, or Mars Colony, which are booming. However, they still earn good sales because they became normal products for people to use. Coca-Cola can be drank by anyone, even those in rural areas or those who live near or in the mountainsides. There are exceptions, of course, like those with allergies, health requirements, or if they prefer healthy drinks. Traders with short-term perspectives can benefit from short selling or buying stocks when there's high inflation due to an unstable stock market. Still, this depends on your investment plans and research. If you have a long-term perspective in investing, growth stocks are good because they have the potential for high returns in the future, just not now. You can hold their stocks until they reach maturity, like Coca-Cola, until they pay better than average yields. Income shares or stocks can go well with inflation since they give out regular and stable dividends. Prices will decline until they're able to match the inflation. What's the common word for investors? Buy low, sell high. So what? I'm here to learn to hedge against inflation also. Oh, for that, we've already talked about those. Okay, so let's give a summary. Number 1. Short selling or buying will do. Growth and income stocks will decline at this point. Number 2. Commodities or ETFs. Exchange trade funds is another way, but research and analyze before jumping into it. An example is gold. Number 3. REITs or real estate investment trusts can be a good choice. These are not so volatile like stocks, so real estate agents or those investors with keen eyes during 2020 and 2021 actually bought more property than selling. Inflation also increases the value of properties, so owners and investors will benefit more. Number 4. Let's just add cryptocurrencies. These are still being argued here, but it's because these don't decline like cash during inflations. But note also that these are very risky, so a small percentage in the portfolio can do. Bitcoin reached its peak last year in November 7, 2021 at $67,549.14 if it becomes more popular and widely used, hence resulting to increase in demand. While there are only 12 million bitcoins, the price will continue to rise in the future. The opposite could happen though if demand and popularity decrease, which will surely cause the prices to drop since there are more supply. Number 5, of course, we must never forget to diversify our portfolio, especially during a high inflation, because different stocks or companies perform differently here. This is especially true for beginners, since we are unlike Warren Buffett, Charlie Munger, and Bill William Albert Ackman. Maybe you could prefer Marius if you knew what you're doing like them. Let's also remember that Buffett said that earnings are not the main variable if you as the owner really earn during high inflations. Increase in purchasing power is the only increase in investment. You may feel richer, but you won't eat richer. This means if your investment appreciated to $10 million, if you include dividends and taxes but your purchasing power is decreased, you don't really have any income or returns from your investments. He also wrote in 1980 that inflation is man-made. I'll stop the discussion here so that you could at least absorb some of the information. You can just play it again if you didn't comprehend all. For more content like this, like, share, and click subscribe and the notification bell to stay updated during releases. See you soon!